Market access means that a country can access the international financial markets for its financing needs on a durable and substantial basis. Countries with market access often have outstanding euro bonds or similar international bonds. Usually, these countries have their bond yields included in the Emerging Market Bond Index or EMBI index that is maintained by JP Morgan. The spread is the difference between the yield paid by bonds of a government and a reference rate in the same currency, which is commonly considered to be risk-free, such as the yield of US or German government bonds. For countries with access to debt markets, there is useful information available from debt market prices, such as yields and spreads, that can be used to assess the debt distress risk. The market financing tool in the LIC DSF uses this information to produce an additional signal regarding the extent of market financing pressures. In addition, there is important information in the projection of the gross financing need of the public sector. These gross financing needs arise when the public sector's revenues are not enough to finance its expenditures. In other words, when there is a fiscal deficit that requires borrowing by the government. Gross financing needs also arise when the public sector needs funds for debt repayments, which are called amortizations. Higher gross financing needs imply a larger need to access funding sources, which may be difficult or more costly to the government. The LIC DSF compares the maximum gross financing needs as percent of GDP in the baseline scenario from the first 3 years of the projection period against a predefined threshold of 14% of GDP. The LIC DSF also compares the country's EMBI spread in basis point for the latest available year against a predefined threshold of 570 basis points. Mechanical signals from market financing pressures are assessed as follows. Low risk if neither the public gross financing needs nor the bond spreads thresholds is breached. Moderate risk if only one threshold is breached, and high risk if both public gross financing needs and bond spreads breach the thresholds. Finally, it is important to know that the signal from market financing pressures does not directly inform the mechanical risk rating, but it may inform judgment.